Are you or someone you know looking to buy or sell a home? When you use a HomeGain realtor to buy or sell a home, you can get $150. Visit HomeGain.com and click on the Promo 150 banner at the top of the page to get started. Compare HomeGain realtors and choose your favorite. Complete your home purchase or sale transaction with a HomeGain realtor, and HomeGain will pay you $150. Get started today by going to HomeGain.com.
Welcome back to Real Estate 360 Live. I'm your host, Ryan Sloper, joined today by my guest, Louis Cammarosano, the general manager of HomeGain. Quick reminder, Real Estate 360 is designed to build the Washington, D.C. Metro's housing or credit markets one house at a time. If you ever have any questions, concerns, or real estate needs, the best number to reach out to us is 877-245-2030. That's 877-245-2030, or via the web at realestate360live.com. That's realestate360live.com. So I've had a lot of questions lately in regards to trying to get approved for a mortgage and having problems, and how can, what can they do to make a loan stronger? And I wanted to kind of address these today. They're called the 4 C's of mortgage underwriting, and that's kind of been the unique thing for the last 25 years. They're called the 4 C's, which are capacity, credit, cash, and collateral. Now, these are really the guidelines, and risk tolerances change, but the core criteria does not. The first one that I want to touch base on is the capacity, which is the analysis of comparing a borrower's income to their proposed debt. It basically considers the borrower's ability to repay the mortgage, and the lender's looking at 2 calculations that we call ratios, or debt-to-income ratios. The first is your housing ratio, which is just simply a percentage of your proposed total mortgage payment, which includes principal and interest, real estate taxes, homeowner's insurance, and, if applicable, flood insurance and mortgage insurance, divided by your monthly gross income or pre-tax income. Now, a solid housing ratio by Fannie Mae's and Freddie Mac standards is 28% or less. Although, many times that I've seen, it's actually been much higher than 28. We've seen up to like even 40 sometimes. The back-end ratio, which is your overall debt-to-income ratio, starts with that mortgage payment calculation from the housing ratio, and also adds in all other recurring debts that would show up on your credit report, like auto loans, student loans, credit cards, anything of that nature that would show up on your credit cards. Now, a lot of people think that, hey, are my cell phone bill going to show up on there? Is my car insurance going to show up on there? None of that stuff's going to show up, because it's not required, to be on your credit report. Most of the time, they might pull your credit for a cell phone bill or pull it, but they're not reporting, unless obviously you go late and it turns into a collection. So those are the ratios that lenders and banks are going to look at to determine, as a percentage of income, how much money you're spending out for your mortgage payment, and how much for your mortgage payment and all your other debts. Now, the thing is that you can't just, say one person is going to fit one ratio and another person is going to fit a different one, because sometimes people can go up to a 56, 57% back-end ratio, total debt-to-income ratio, and other people can't go any higher than 45. And that's because there's other factors. The second one being credit. Credit is basically, everybody knows what credit is. They give you a credit score. It's a statistical prediction of a borrower's future payment likelihood. So they just review your past factors of whether you paid on time, whether you have any collections, and they look at the overall revolving period that you've had that credit. So your credit score and how stay on top of your credit you've been in the past 3 to 4 to 5 years is the second critical component. So if your credit's good and your qualifying ratios are good, you're halfway there. The next is cash, and cash is going to be a review of your assets, meaning your money in your checking, your savings, your retirement accounts, stocks, bonds, anything else that you may have. And there's 2 different parts to the cash. How much are you going to put down as a down payment, and how much money do you have in reserves after you put down your down payment? And the lender looks at these as, okay, well, if somebody's willing to put down, $50,000, they are at less risk to default on this loan as somebody that's only putting $5,000 down. And also the second part to that being, if they have $50,000 in the bank in reserves versus another person that only has $10,000, they're less likely to default. So really, these things start to weigh back and forth. So if you're not as strong on one but stronger on another, you can probably compensate and you have a better chance to get your loan through. The last is collateral, which is obviously the property that you're buying, and it's referred to the appraisal of your home. And every lender and bank's going to require an appraisal for the most part to determine what other homes have sold in that area, the subdivision, or within a mile. Most lenders like to have it within a mile unless it's rural, then they can go outside of that. But they want to have an idea of what the true value of this property is as of the date you're trying to obtain a loan in case they have to foreclose. So with all that being said, one person could have higher ratios because they have, more cash and better credit. And sometimes it can go the other way. The most important thing that I tell everybody is that everybody's situation is different. And the most important thing you can do is to reach out to a professional that can analyze your overall situation and determine, okay, I'm not as strong here. What do I need to do to make my file stronger? A lot of the times it's just as simple as getting your credit score up instead of being a 680 to a 720. That might let your debt to income ratios go up. Now, what lenders and banks will typically do is they'll allow for higher debt to income ratios, but that doesn't mean that you guys, just because you're approved of that, you have to go through with a loan, because ultimately they're taking into consideration your gross income. A lot of people tend to overextend themselves because you're working off the gross income and not the net income that they actually have coming to them. So most people will actually qualify for more than they should or more than they want to. And I think, Lewis, that's one of the big things. And that within the last 3 or 4 years, that's exactly what people did. They overextended themselves. And one of the most interesting things is that lenders haven't really adjusted their debt to income ratios as much as I would think that they should. I've seen where there's been front end ratios, so just the mortgage payment divided into what their gross monthly income is at 40%. Now, wouldn't you agree that that's kind of high?
Well, it depends on what their risk tolerance is and how much money they're going to make. So
yeah.
It is high. But
yeah, and it's, if they have money saved up in the bank and they've got enough for, a cushion, and that's what they're using it for, then probably so. But that was commonplace, back 3 or 4 years ago. Now, the only difference is that on most of these cases, you need to have some sort of other compensating factor. So the most important thing is obviously get your credit pulled first so you can figure out where you stand credit-wise. Look over what your cash position is so you can figure out if you're going to need to put a larger down payment so you can maybe source those funds, or you can take more time to save up a down payment over the next 6 months to 12 months. Keep in mind that there are plenty of programs out there, a lot of state-funded programs, and Virginia, the Virginia Housing Development Authority, which offers a 0% down payment. Now, with those programs, it's important to remember that the qualifying ratios are going to be more stringent, that you're going to have better credit scores than a regular loan, like an FHA loan. They might allow you down to 640 credit scores. You might need a 680, a 700 on these other programs because they're just, they're more particular about who they allow to have these loans. Now, that doesn't rule you out just because you don't have it right now. I think, we speak to a lot of people that right now are on the border of being able to qualify for that. Sometimes it only takes 30 days and you can get that stuff cleaned up. And it's well worth it. If you're able to get, 100% financing, nothing out of your pocket, maybe $500 or so because the seller paid your closing costs, and you're able to take advantage of the low interest rates, it makes sense, especially if the payment's cheaper than what you would pay in rent. And in a lot of cases, Lewis, that is holding true, especially in the DC metro area, just because of the rental increases that have been taking place over the last year. So, without you calling in and finding out, hey, what are my options? You might not even know, and you could be saying to yourself, well, I'm never going to qualify for a loan, because I know there's a lot of people that think that. But the longer you keep saying that, the further you're pushing yourself away from actually owning a home. If you're proactive about it right now, and you want to take control of your financial situation, your credit scores, which you need inevitably for everything, because you're going to have to buy a car, you're going to have to probably take out credit cards, and if you own a business, you need credit. Everybody needs it. So whether you're planning on buying a home, tomorrow or 3 years from now, you need to take care of your credit today. We talk about this every week, but it is a critical component, especially for business owners. I can't tell you how many business owners are struggling now because they can't obtain any credit. Obviously there's all this low interest rate environment and there's money out there, but it's impossible to get from the banks unless you have superior credit. I definitely have a guy that I recommend, Rondy Lambeth, if you wish to get your credit looked at. you can call me and I gladly put you in contact with him. It's 877-245-2030. That's 877-245-2030. We're coming up on the end of the show. Lewis, I'd be delighted if you would tell our listeners and real estate agents that listen to the show where they can go to, to check out home values. If people want to get connected with an agent, what should they do next?
Just go to HomeGain.com if you're looking to buy or sell a home and get a quality real estate agent and also get $150 back when you complete the transaction. You click on the Find a Realtor tab, and there you'll be able to fill out your profile, what you're looking for in a real estate agent, and we'll hook you up with a number of real estate agents who will propose to you anonymously. You can compare them, and you pick the right one and make sure that you get the right one instead of just flipping through the yellow pages or going online and looking at profiles. You can get a free home valuation by typing in your address, or you can view all the homes for sale that we have on HomeGain, or check out a lot of the market research. All of the above that I just mentioned are available on the homepage of HomeGain, HomeGain.com. You can go there and get all your real estate needs taken care of. Thanks, Ryan. Thanks, everyone.
Thanks, Lewis. Appreciate it. Guys, if you have any questions or concerns, real estate needs from me, reach out to the off-air number. It's 877-245-2030. That's 877-245-2030. Or you can ask me a question on the website. It's realestate360live.com. There's an Ask a Question button on the right-hand sidebar. Just click that, enter in your name and email and phone number, and I'd be glad to get back to you by the end of today. I want to thank you guys for tuning in again this Monday. We'll be back again next Monday from 2 to 3 p.m. Have a great week, and talk to you soon.